Well, good afternoon, everybody. Welcome to the February 11th, 2025 edition of Bull Sessions. My name is Mark Robertson. I am here with the beads on with my dear friend Ken Kavula. Good afternoon, Ken.
Good afternoon, Mark. It's Mardi Gras time, huh? Is today Mardi Gras?
I think we're getting close, but New
Oh,
Orleans was pretty much on the radar screen for everybody this weekend. So
Mardi Gras has to be on a Tuesday, so it's either this week or maybe it's a week coming up yet. Our audience will tell us in a couple
I
minutes. I'm
they will.
positive. So,
And if they tell me it's now, that means we're supposed to have some of those punchkis. And my waistline's not ready for punchkis right now.
punchkis are for Lent. We,
Yeah, but you start them on Fat Tuesday, right?
right, but the punchki people don't celebrate Mardi Gras. We celebrate donuts.
All right.
Either
Well,
or.
all right. Well, that other voice you hear is Kim Butcher from Florida. Kim is. Are you poolside with your umbrella drink, Kim, or?
I am not. I'm in the condo, so I will apologize in advance if at any time you start hearing a jackhammer. They're working nearby, and already with Mark and Ken, they went, "Oh, what is that noise?" Click. And I muted myself. So yeah.
Or,
If it gets
Here's
bad, I'll send a note saying, "Forget it. I'm going to the pool. I can't take it anymore."
there you go.
Nick. Nick wins the award for first one to tell us when Mardi Gras is. Mardi Gras is on March 4th this year, Mark. So we have 3 or 4 weeks yet left.
Okay. Well, maybe if we head to New Orleans, we'll still be there. So the last time Ken and I were in New Orleans, what a fantastic time with the Louisiana chapter for Better Investing. But we ended up, because there was a Chicago Bears football game at the same time, we ended up there for what, 4 days, Ken?
More days than we thought we were going to.
So we'll go back. We'll go back. But good times. All right, we are going to talk a little bit more about the Groundhog Challenge. We won't spend a tremendous amount of time on it, but we will look at our all-time leaders. We do want to look at the 2025 consensus selections because I think you guys have chosen a number of interesting stocks, and we do want to talk just a little bit about an industry study involving restaurants. So with that, Ken, I will go ahead and get us underway.
Sounds good.
All right. On the left is the real reason that New Orleans is busy right now, or was busy. The Super Bowl was there this weekend, and I have to confess I didn't watch a whole lot of the Super Bowl, but I watched some of it. And I usually save the commercials for Monday morning, but interesting time. I had predicted the night before in a group gathering that it would be a blowout win by the Eagles, so I'll take that one.
Yeah, conversation. Who knows if that's true?
All right, I can get a signed note from my witnesses.
Keep going here.
Okay. All right. This is our weekly reminder that Portillo's is not a sponsor of this session, although they should be. And oh, by the way, they are up about 50% in the last couple of months. So take that, Kevin, even though he's not here. All right, here's our weekly disclaimer. Everything we do here is for educational purposes. No investment recommendation whatsoever is intended. What we are attempting to do within a community, a really powerful, wonderful community of long-term investors, is demonstrate some of the things we've learned over the last several decades from the Modern Investment Club movement. So that's what we're here to do. So we will share thoughts on that, opinions, and please take them as you see fit. Please do your own review and homework before investing in any company mentioned here. If we own something that we talk about, we will try. We make no promises, but we will try to remember to let you know that we own it. I do own shares of Portillo's from the previous slide, but we assume you're smart enough to form your own opinions and make your own decisions about investing, and we are not the boss of you. If you would like copies of the slides, or if you have follow-up questions, or even more importantly, suggestions for future Bulls topics, our two email addresses are there at the bottom of the page. And Ken, we've been getting a fair number of suggestions and requests, and it's a good thing.
I am very pleased with the number of people that took the time to, or take the time to ask a question or write a comment or just say hello. So keep the mail coming in. It's nice to hear, and we'll try to communicate with you as much as we possibly can. By the way, Mark, I read that paragraph about make your own decisions, so I should disclose that I do not own shares of Portillo's. Okay.
Oh, goodness. All right, here's our weekly look at the market. We use the value line arithmetic average. Those are the green quarterly bars that you see on the graphic to represent the stock market. The reason that we use the value line arithmetic average is it is an index which gives us a kind of a readout on small, medium, and large companies because it's an all of the above grouping of the type of companies that we like to invest in. So that's what we like to use to characterize the market. You can see that blue line is just simply a mathematical regression at 10 or 11% over time, and we call that something reasonable to attempt to achieve. And average forecast still right around 9%. And at least for one more week, a quick check-in with Lou Rukeyser. This is an AI demonstration, just simply asking Lou Rukeyser to give a Wall Street report for the preceding week in his language or voice, and it does a pretty good job. I've been kind of interested in how it generates that output. I practically hear him saying those words. Anything else here, Ken?
No, it's always nice to have those green bars touching that blue bar or very close to that blue bar. I get a little bit antsy when the green bars get way above the blue, and a little bit worried on the other direction when they fall too much below the blue. So we're right on the blue right now, and that's good.
Yep. Things have settled down. All right, here's a quick look at stuff we'll talk about today. I know it's a little bit of a busy slide, but it's looking back 20 years, going back to Groundhog Day 20 years ago when we first started, and looking at the progress of a variety of things, including the 10 most widely followed companies that manifest, starting with NVIDIA and working your way down the page. Towards the bottom third of the chart, you see what we call Index Central. You could have invested, there are usually investment vehicles for most of those stock market indices, and you can see how they have done over time. We do use this to point out the two of our favorite demonstrations. The Tin Cup demonstration is a 401k demonstration going all the way back to 1994 that has done very well. And then, of course, our monthly investing roundtable, where 3 or 4 or 5 of us come together and share an investing idea, and we keep track of how well we do. And you can see that the answer to that is pretty well. All right, so we're going to do two things here today. We want to talk about restaurants. You can invest in all the restaurants using this EATS Advisor Shares ETF, and I just find it kind of interesting that hasn't done very well. Actually lagging the market by about 6 points. So then I thought to myself, well, what if I just go and buy the burgers and sodas and chips and all that kind of stuff, go down to this First Trust Food and Beverage? I figured, well, maybe that's a way to do a little bit better, and I don't care which restaurant or grocery store sells them. I was a bit stunned by this, Ken. This is literally Pepsi, Coke, you name it, those type of companies. And over the last basically 9 or 10 years, 3%. It's a very defensive listing of companies, and I'm just a little bit fascinated that that's as low as it is. So.
Mark, for for 15 or 20 years, I've been studying industries, and when we get into consumer discretionary, I'm always struck by the dichotomy. They talk about barbells, and almost every consumer discretionary industry that I can point to is really a barbell in relief for you to take a look at. There's a small group of companies at the top that are doing well, and a little bit larger group of companies at the bottom doing extremely badly, and then there's a whole bunch in the middle that are not doing as well as you might expect because they don't get get the news coverage. They don't get the press. So you tend to think that the industry is doing better because you hear about the better performing companies. I think that's very true in the restaurant industry that we're going to look at today.
And some of them end up spending too much on a Super Bowl commercial, and that gets them too.
That might be part of it. Yeah.
Anyhow, one of the other things that we've talked about here briefly is a bit of frustration with Gentex. Some of the people in the audience own shares of Gentex, and it's one of our favorites. It's in the Buttonwood portfolio, and you can see a 10-year look back gives you a return of 5.8%. And then if you go back 20 years, which catches a little bit more of a longer-term economic cycle, you do end up here closer to market performance, and they're in kind of a bad spot. So we want to roll up a little bit and chat about Gentex here. So we'll go ahead and get underway. All right, we'll start with a question we got from Carol from Maryland. She's just basically noticing a difference between two published sources of data and asked us, what's up with that? So Ken, what are your thoughts here? I mean,
well, when you're looking at data, folks, the time periods that data includes are so very, very important. I know all of you, if you're in a club, an investing club, I know that your treasurer understands the importance of dates when they put data into the system, because the value of something changes almost daily whenever it's being traded. And so that affects the unit value of your club, that affects the growth of the stock that you're looking at, and where the start and where the finish are. If you're going to really compare those things, you have to start at the same point and end at the same point in order to see if the numbers are comparable. If you'll notice, not very many of these start at the same point and end at the same point. The performance on Value Line up there is trying to show you what's happening in a 1 year, 3 year, and 5 year period. The same thing's happening with Iradamed down at the Yahoo Finance site, but notice how they are starting at different places. And I know that you think to yourself, it shouldn't make much difference when you change 2 months, but in fact it does. It can sometimes make dramatic differences. And we're starting to see those dramatic differences occur when you compare these two data sources like this.
Mm-hmm. All right, so it's just a reality. Again, first check the dates. The dates are different on the 2 points. And by the way, this 11/8 date for Value Line is actually 11/1. By the time that they go to press, their numbers, the prices that are on the company report is usually 1 week old. They release them on Friday night or Saturday morning, and usually the analyst has turned in that piece of paper a week beforehand. You can actually go back and check that using price data. So 11/8 is actually 11/1. The 3.69 here, I think, is just a mistake. It's an error because the real number is right there, that 42. So it's probably meant to be 36.9 if I had to guess. And the other thing to keep in mind, just in general, when you're looking at comparisons of sources, sometimes they're listing simple price appreciation. Other times they're including the effect of dividends, and those are known as total return prices. Now, we use total return prices for everything that manifests. So if you go and look up some of these prices right here and go back and check the price on that date, it might be different. The reason it'll be different is because they are dividend adjusted in the numbers that we use. Okay.
Yeah, and Mark, those people that are reading Value Line or Yahoo Finance or any other data source and thinking that it's perfect need to understand that there is no data source anywhere that doesn't have errors in it. And the more data that you have, the more errors there probably are. I know it's surprising to see an error like we pointed out on the 1 year return right there, but they exist, and Value Line does its best. If you send them an error that you perceive, they will either send you a note back telling you, yes, indeed, it is an error and we've adjusted it, or no, indeed, it isn't an error, and then they'll go on to tell you why it isn't. Value Line is very communicative, especially if you have your own subscription. So don't be afraid to question occasionally a number that you think is just way out of whack.
And that gives us also an opportunity to point out that Value Line has on YouTube a thing they call our one stock to buy right now. And they've been running this for a couple of years. We cover it here at Bull Sessions, but that is also an opportunity to talk to them live. So just put that out there. All right, and this isn't so much a question as just an observation. I had helped one of our subscribers figure out how to get to the worksheets that we use when we are doing our what if sandbox type stuff with portfolios and dashboards. And this actually shows you up here on the upper right. Instead of using the edit button, you use this little button to the right of it, and that opens up this menu, and you can go into the worksheet option like you've seen us do here for Buttonwood and some of the other portfolios we look at. So you go into that. When you do that, you want to, and you're starting with a clean study or a clean analysis, you want to hit that reset button to reset it to the current actual companies, current prices, and all that stuff. So and then have fun. So again, that's just to clear up some of the mystery as to how do you get to that worksheet function. So grab a dashboard from your portfolios, give it a try.
One more hint, Mark, from a person that uses these worksheets all the time. When you get in the middle of a worksheet and you've made so many changes, you forget what you did. It's sometimes very helpful just to hit reset and start over again. And this time, instead of talking about things you want to do and then decided you didn't want to do, just follow the line of thinking about things you wanted to do, and it'll very, very quickly you can get back to where you were. And this time you'll know what is happening. So you can reset that thing as often as you want back to the original.
Absolutely. Okay, so let's go ahead. We're going to visit our groundhog situation, look at the long-term results here today. And again, if you're new to our groundhog and you're new to this name here or this name here, first one is Arnold Bernard, second one is Walter Slosh. Your homework could be go out and Google it, or even better yet, go to the site, search on Manifest Investing and enter those, because that'll take you directly to a series of discussions on the teachings of Walter Slosh. Who is he? One of Warren Buffett's best friends, who also was a student of Ben Graham. Arnold Bernard is the inventor of Value Line. So that's your homework if you want to follow some of those people. Here's a quick reminder that
Mark, before we get too far away from that worksheet, can you go back to 2 slides? And I want to answer a question from Sandy out in the audience, okay? Sandy wants to know, can you sell partial shares on the worksheet? Absolutely, because the worksheet's going to ask you to put down how many shares are left. So if you have 10 shares and you want to sell one of them, then you put 9 shares and the computer will know that you sold one, there's one less than you had. If you want to sell 1.5 shares, then you put 8.5, and then the computer knows that you sold 8.5. You can also do it the other way. If you want to buy a share and a half, you go from 10 to 11.5 in the box, and the computer will adjust the cash to make sure that you're buying or selling depending on how many shares you're showing at the end of the transaction.
Absolutely. So use that edit button that I've circled there in the middle of the screen. All right. So back to the groundhog. We had a pretty good year, but we just came in just a tiny bit underneath the market. We'll be taking a closer look at accuracy. We actually had a pretty good year with accuracy. And keep in mind this range when we get to a few pages in, that is what an average investor experiences. This is not a group of average investors by any means. All right. Here are the smiling faces. These are the real people behind. These are the real groundhogs, and I won't spend too much time on it other than to say we'll be adding a few pictures to this list based on how the all-time standings go. It's a bunch of better than average investors. Now this is tough. This is our band of crackerjack accountants that come in and do all the calculations for us every year, captured on the screen there. And I do think that's an interesting, perhaps life words to live by on the right.
Click. Let's move on.
My wife saw this and said, "I dare you to send that to any accountants that you know." I said, well, look, they've been working hard on the results. So
Mr. Galugli wants to know if that's your board in Manifest, Mark. Is that your board of directors? He wants to know. Okay.
It very well could be. All right, so here we're looking at the all-time results. Again, you become eligible for this after 3 years of participation. What you're looking at here is numbers 26 through 54. And these are all good numbers. These people are basically beating the market during their years of participation. And you can see it starts off with Kim up there at the top and a number of very familiar names that you are all very familiar with. You can see a number of Ken's 19 investment clubs have snuck on the list here. And some good years turned in by that group out in Spokane, Washington. You can see a couple of 50s. Ellen Hall had a great year. She's been with us all 18 years, moved up from 40 to 32nd. What else do we see here, Ken, that I'm forgetting?
Well, I like to look at the years held column, and I especially have a lot of really good feelings for folks that are sitting at 15, 16, 17, 18 years and still beating the market. I think that's a real feat. I don't want to disparage those of you that only have 3 or 4 years of experience, but that's a little bit easier than doing it for 15 or more years, I'll tell you.
Welcome to the party. So good stuff. So here is the top 25. And again, a whole bunch of people with double-digit years of participation. And again, you see the results for last year, Jim Gallagher coming in, and it's his 3rd year of participation. So he makes the list with an average return of 32% per year. And as you go down the list, you can see there are 4 newcomers that qualified with their 3 years of participation and a number of familiar names. I noticed that Ralph moved up from 34th to 21st. Check out Marie Frank going from 94th to 19th. And Marie, of course, is a source of a lot of good stuff on the forum. And what do you take away here, Ken?
Well, when you have not a whole lot of years in, it only takes one of those smaller numbers of years, hit a home run, and boy, you can move up this list quickly. As your number in the years column gets bigger, you tend to move much more slowly up and down, in both directions on the list. So it's a really interesting testament to the fact that some people that aren't professionals over long periods of time can really do a pretty decent job of stock picking. Now I'll tell you that stock picking where you can't make a change for a whole year and where you're limited to 5 to 15 stocks, that's a very specific kind of skill. But I do think that it points to people that have the ability to make that skill work for them in building their portfolios. Look at that accuracy column, Mark. The number of people that have been accurate 50% or more of the time. And then compare that accuracy to the number of years. Mark, you don't talk about yourself too often, but I see a 55 accuracy in 18 years. And I think that's pretty intense. Not quite as intense as the 56 accuracy in the 18 years by your partner, but still very intense. Okay.
Although, we have talked a lot about the Tillinghast number of if you get to a point where you pick 11 out of 20 stocks that beat the market, your numbers can look pretty good. And you just look at the top of this chart and the 55s through 60s. And I think there's a 65.4 on here. Yeah, Space Coast in Florida. They came on the scene here 4 years ago, and look at what they've done over the last 4 years here at number 7. First of all, 2 out of every 3 picks coming in and beating the market by 6 percentage points over that time frame, including 2 championships. So that's cool. And then, of course, you see the Broad Assets and Bauer Cities duking it out. They both have been with us over a decade, and that's just a great fur fight. And then, of course, this one we really like to acknowledge, one of Ken's favorites. They haven't won yet, but every year they've been like second or third for 6 years.
And look at that relative return for that club, Mark. 6 years beating the market on average by 12 plus points. It's superb. And to be able to do that for a 6-year period, I want to see it again at year 10 and year 15. But I think it's impressive just to be able to do it for 6 years.
And giving credit where credit is due, this is Herb Lemkool's family club. Basically stocked with his children. We've met his daughter Cheryl. She is wonderful, and it's just wonderful to see a club achieve this level of performance over time. Herb is in the top 40 also all time. So some good clean fun. I just got an entry.
Kevin wants to know if the cool kids are superb or super herb.
Yes.
Both.
There you go. All right, enough with that. Here is the current standings. Groundhogs are out of the gate pretty hard. I mean, hard in a good way. Their average return is 3%. The market's only gone up 0.3. About 3/4 of them, 72% of them are beating the market at this point. The monkey is starting down here at 136th. That makes Ken happy. This is just amazing. We're going to have approximately 200 entries this year, and the value line arithmetic average being down again. And again, it's only, what would we say, 6 days of trading, Ken, or something like that?
So, yeah, 5 or 6 or 7, something like that. Yep.
So you can't get too excited, but we do notice that Kevin has scrambled onto the list at 42, and there's a number of Ken's entries in here. Here is that Heart of Illinois Breakfast Club group that we've been hanging out with. They're doing very well out of the gate. Ken and Kurt at 15 and 16, and our colleague Sean Mace sneaking in there for the early lead. Marie Frank back at number 4. Broad Assets is back at number 3. They just won't go away. And it's early, but fun.
We'll add that next week, or the last week column, once we have a couple of weeks under our belt, folks. Okay, if you're looking for it.
Yep. We'll compare to how they move around. And this has become kind of standard feature here, so. All right.
Nick wants to know how many of the top participants have chosen Palantir. Any idea, Mark, what the number on that one is?
I know that it's in the top 16 because it's on this list.
Okay.
And I'm guessing 25 to 30 of the Groundhogs chose Palantir. And it's obviously doing quite well so far. We'll see. But this is a pretty good list of companies. I mean, Ken and I were talking before the session. I'd be quite comfortable owning this portfolio. I mean, how many of these do you own to begin with, Ken?
Yeah, I look at it and I say to myself, in a club or personally, do I own 3 or 4 of them? And if I do, then it's a list I'm very interested in. And I want to pick out the companies that I don't know very much about once I decide that it's a pretty decent list. So I'm going to check out Opera. I don't know very much about Opera. I'm going to check out Argan. ARGAN. I don't know very much about that. I happen to know a little bit about most of the rest of the list, but I look at lots and lots of stocks day to day. So maybe there's 5 or 6 on the list that you don't know very much about. I probably, in a club portfolio or in my own portfolio, Mark, probably 8 or 9 of these are sitting in one of the 2 places. Yeah.
Well, in full disclosure, I own some Palantir, own some NVIDIA, own some ASML, own some NICE. Our largest family position is in Microsoft. Own some of Matt's Green Brick Partners. Own some Amazon. Own some Alphabet. Should own some Credo. That's our top performing best small company for the next year, and we own a pretty good amount of Novo. So, like I said, I only have to add the ones that I didn't put check marks by. So the community is interested in the type of stocks that we are. But Nick, it's probably 25 or 30 for both Palantir and NVIDIA, and Novo got quite a few selections also. All right. Here at number 17 is the Moby Stock Service, and I kept getting solicitations from them, finally caved in and wanted to check them out. This is the Moby portfolio and where it actually comes from. And you can see on the left there that that's a pretty good collection of stocks also. And a number of stocks that have shown up on some of our screens, including this one we talked about a couple of weeks ago. And took a long, hard look at this one for my Groundhog portfolio and didn't end up with it. But they have a decent appearing track record. You can see that it's a group of guys that are leaning on some Goldman Sachs and Morgan Stanley research. Those are both pretty high-powered firms. So we're just keeping track. It's one of our keeping track portfolios as a celebrity Groundhog entry. And there's some good studies on that list. Anything else on this one, Ken?
No, this is an interesting thing. Mark, is this a pay site or is this a free site?
You can get inundated with free mail from them, and you can get away with a little bit of stuff, but I did go ahead and get a trial subscription. And here is a review if you want a little bit more information on who they are, what they do, and what they've done. That's where that graphic came from. So have some fun. All right, here's another fun moment. I don't know if Bakul's in the audience. We can check real quick. We were sitting around with our Heart of Illinois brethren, just kind of talking stocks a little bit, and this came up from Bakul. And as you may recall, we talked about NICE. There's many of you out in the audience have either followed the company or own the company. We said the only thing wrong with this company is that their accomplished leader of a couple of decades, Barack Ilam, had left the company recently, end of last year, and Bakul actually figured out where he turned up. So we were talking about this. He showed up on an 8K for FactSet Research. And his role there has been described as strategy and talent acquisition. And that is enough. I know that many of you out there already own FactSet Research, FDS. It's a reason to be interested in this company because I believe that he will come in and do. You may remember we talked about this as being one of those companies that did artificial intelligence, AI, before it was cool, and by several years. And your thoughts here, Ken?
Well, I brought NICE to the roundtable a year and a half or so ago and made the very point that you just made, that they've been talking about AI for the last 4 or 5 years. They've been applying artificial intelligence to a lot of the business that they do. I've owned FactSet. My wife has owned it in her IRA for probably 20 or more years. And it's a company that's not going to go anywhere in our investment portfolio. We think it's the cream of the crop in the niche that it occupies. We think it had wonderful, wonderful leadership, and we have great faith it's going to continue to have wonderful management. And we don't see any reason to move FactSet away from the stocks that we own. It's not always a buy, but we've we've made the decision after the number of years we've held it to hold on no matter what goes on with FactSet and make it a part of our investing portfolios. I like the concept of this guy from NICE now sitting on the board of FactSet and bringing his expertise to help them land some talent, maybe move them to the next generation when it comes to data.
Yeah, and Bakul is an expert in this realm as far as when it comes to data and that type of stuff, working out in Silicon Valley. And I also want to tip my hat just to the guys from the heart of Illinois, Steve Emmerich and Dave Roberts, and they have encouraged this notion of occasional, um, off the cuff, freewheeling discussions about anything. That's where this came from. I mean, we're literally sitting there just chatting about stocks and investing in general, and Bakul shared this, and so I think it's a great example. We'll look for other opportunities to do similar things without getting carried away. But we do know that the power of this community is unearthing something like this. Kim does it about weekly, so good stuff. All right, so let's go ahead and take a look at an industry study inspired by this article at Insider Monkey. It's a couple months old. Been waiting for the most recent update from Value Line. The restaurant stocks are in this week's update batch or edition from Value Line. So inspired by this article, we thought we'd take a look at, well, what do they think the 10 best restaurant stocks were back right around, just short of Thanksgiving. And one of Ken's favorite subjects is industry studies, so let's have some fun. I don't think this is what you generally look at with an industry study, though, Ken. Am I out of bounds here?
I think you're a little bit out of bounds, Mark. It intrigues me that Portillo's is on the list after all the talk about Portillo's for the last couple of years. But I have had to make a decision about industries as we've studied them in the clubs I belong to, and as I've spent the number of years developing a really nice way of putting together a group of 5 or 6 of the very best from the industry, and then guiding the club to try to choose the best out of the group, led by Nicholson's very short quote of "buy the best." He always was encouraging folks to go to the peer group and to buy the best in the peer group. And if the best wasn't on sale, to wait, to be patient, not to settle for the 4th one down the list or the 12th one down the list, and not to chase performance. So I had to make a decision pretty quickly when I started studying industries, Mark. Was I going to be swayed by lists like this, or was I going to believe in quality? And I'd come down hard and fast on the concept of quality. That's up straight and parallel, and that's where I believe the majority of the portfolio has to be aimed. I'll play in the sandbox of non-quality occasionally. Witness my purchase of LAZR, but for the most part, I'm sticking with 85 or 90% of all my portfolios in this up straight and parallel quality realm.
Oh, sure.
And folks, except for one exception on this list, the other 9 have visual analysis that will drive, if you're a true better investor, it'll drive you just crazy, or you'll just sit there giggling at them as you pull them up one by one. The exception to the rule that does have a really nice visual analysis is number 9, QSR. But if you are intrigued by the visual analysis, I would urge you to dig a little bit deeper, because QSR has its own very unique set of problems going on right now.
Yep. So number 10, that one's for you, Kevin Gologly. There you go. And the one thing here, this is based entirely on anticipated potential price appreciation over the next year, and this is tempting. It's also a minefield, as we're going to show you here. So here is a look at the companies in the restaurant industry designation. from top to bottom. They're obviously ranked by their quality. Those are the components of quality on the right. And we do, like Ken said, 80 or 90% of our shopping is at the top of this list. And the ones at the bottom should be regarded as potentially dangerous. Except for the case of this one right here. This one is an up and comer. So we're going to talk about that one.
Well, I'm looking at the one they picked number 1. It has a quality rating of 2. So please make sure it's in the non-traditional part of your portfolio if you're going to put your money down.
If you're going to go for that, I think you're walking through a minefield. In fact, the one closest to my house, you can't even tell it's open. And that's even after you walk in, you can't tell it's open. So they're having some issues for sure.
When my grandkids were in the older single digits and up to about 13 or 14, Red Robin was the place to take them. They just thought that was the best place in the world. And if I suggest Red Robin right now, I get eye rolls and giggles and everything. So we haven't been inside a Red Robin probably in 8 years now. So yeah.
All right, so let's dig in a little bit deeper, show you where those quality rankings come from. This is that same list of companies, those same characteristics. And again, pretty straightforward when you talk about the financial strength of a company, the financial strength index. That's a compilation of a number of inputs, including their debt structure, capital structure, and that kind of stuff. So that's in here. The straightness, up straight and parallel. Anything close to 100 would be a perfectly straight line. 0, just the opposite. So you can see from top to bottom. And I think as you look at these lists, as you see the higher components at the top and descending as you go down the chart, just allow your eye to drift from top to bottom. The more stable companies, the more consistent companies are up here at the top of this chart and declining pretty much as they go down. So those first two are very intuitive. The stability, the consistency of earnings, and the financial strength. And then we make 2 comparisons. We take a look at the growth rate of the company versus the industry average. That's the relative growth. And then we score that and rank it. And then we do the same thing for profitability. So this green column is the sales growth forecast for these companies. And Ken, you were surprised to see the number of double digits here, huh?
I really was. I was not expecting to see companies growing in the mid-teens or higher in the restaurant industry. I live in a place in the country where there's not a lot of growth going on. There's not a lot of building going on, and I guess I've been inured to the fact that there are places in the country where things are much better than in my area. I'm really surprised to see these restaurants that are growing in the anywhere from 12% on up. Those really pique my interest and would make it near the top of a beginning list for an industry study. I think it also works in the opposite way, Mark, where we're not going to study McDonald's in the restaurant industry study that we're putting together for one of the clubs that I belong to. We're not going to study McDonald's, and we're not going to study it because of its sales growth.
Yeah, it's just huge.
Right, and Domino's Pizza is another one that while it gets a lot of good press and has a lot of good things going for it, that 4% sales growth is awfully hard to get past.
Yeah, some of the numbers are pumped up a little bit, in my opinion, in Mark's opinion, because I think some of the analysts following these companies are a little bit hyperventilating. I do notice that these 2 or even these 3, Cava and Dutch Brothers, showed up on a number of Groundhog portfolios, and they are turning in some numbers. And so when it comes to growth, so to the right of that is the net margin percentage, projected net margin. That is the one area where McDonald's is just off the charts. I mean, that number doesn't even belong on the page. We'll show you that in picture form in a minute. But I mean, the more Taco Bell, who'd have thought Taco Bell, Yum Brands would be so profitable? But they are the second highest profitability on the chart.
I think we should point out, Mark, that in various contests that we've been associated with, including our best small companies list, we've had restaurants surprise us a number of times with winning the whole thing, coming out #1. Texas Roadhouse is quite a study. I would urge you to take a real serious look at Texas Roadhouse and some of the other ones that are growing at these rates. They're not all believable, but when you put together some of the things that are going on in restaurants with the increased labor costs and the increased food costs and everything else, some of these restaurants have figured out very novel ways to solve the problem of putting people in the seat and selling them food.
And then, of course, the other thing you can do, McDonald's is actually doing pretty well internationally, and this is a bunch of international franchises in Latin America for McDonald's, I believe. And that showed up in a few Groundhog portfolios, Arcos, Dorados, and can be one of those situations where that's an improving picture over time. So it could be worth taking a closer look. And we have to point out, Ken, Wingstop is one of those companies that completely stunned us with the best performance in our best small companies group a few years ago.
Absolutely, yeah, absolutely. I guess, Mark, we should also say, because I find it happening in clubs pretty frequently, that you shouldn't, when you're looking at consumer discretionary stocks, you shouldn't be confusing the product with the stock. I won't use restaurants as an example, but just because 5 of the folks in a group don't like the clothes that are being sold by a certain clothes manufacturer doesn't mean the stock might not be quite a performer and be making good money. So try to separate yourself from whether you like the restaurant itself and whether the stock is a good stock to invest in. They're two separate items, two separate ideas.
Here's a look at all the restaurants. By the way, there's 10,000 restaurant companies out there, 10,000, including all the small private enterprises. But this is kind of what you see happening from the publicly traded restaurants in that industry. And you see the COVID moment, and they came out of the COVID moment and were ramping up pretty strong. It is abating a little bit. So if you look at the math behind those numbers from 2021 out to 26, you're looking at about an 8% growth rate. And that, of course, lines up pretty well with what you see here on this page. And here's the one that probably concerns people a little bit. Even though the sales have been ramping up, the price of some of the products that go into the meals and products that they make have been kind of pressuring their margins a little bit. So it's just something to be aware of, that in general, restaurants from an operating margin or a bottom line net margin perspective have been feeling a little bit of compression. That shows up in the PE ratio. That's the aggregate average PE ratio for the group. And by the way, this point right here is versus this line. That shows you how special McDonald's is when it comes to profitability, which it's almost hard to believe. It is hard to believe. It's not almost hard to believe. Any thoughts here, Ken?
No, you know, we've trained ourselves, Mark, to believe that earnings cannot continually outpace sales. But for some of these restaurants, they've managed to do it for a number of years. Okay. We've also conditioned ourselves to believe that outsized net profits can't be maintained for a large number of years. And we have 1 or 2 examples of companies that have been able to do that.
Yep, absolutely. All right, so here's how the prices have done on that list of 10 from the first page. And here's another in-your-face Kevin Go Ugly moment. 24.9 for Portillo's since before Thanksgiving. And one of them actually outperforming pretty well. But as we suggested, some of those have been a minefield. All right. And here's our quick and dirty industry study focusing in on, this is using Manifest. and just simply looking at the industry, the restaurant industry, and sorting by quality. Again, if I'm looking to study companies in this industry, I'm going to start with the ones at the top and be drawn to a few of these entries. I don't know about this one. Is Luckin Coffee a Chinese company? I should know that. And this one could be interesting as more of a speculation. First watch. So good, clean fun. It lines up with exactly what Ken said instinctively going into it. He thinks Texas Roadhouse and QSR might be worth a closer look. I agree. All right, anything else on this, Ken, before we move into just a quick look at Buttonwood?
I think that it's a very interesting study. And for those of you that are buying stocks without looking at peers before you do, I would urge you to at least look at one or two of the succeeding peers. So often when you start a study with one company in mind, the clubs that I belong to find out that there's another one that's equally good, and a lot of times there's one that's even better than the one you started out with the idea of wanting to purchase.
Yep, without a doubt. All right, so let's go ahead and take a look at the portfolio. We do have $140 in cash if we choose to. We don't have to do anything, Ken, but we might want to. This is the portfolio. The update on Mercado Libre is in, so it's actually at pretty respectable levels here. And you continue to study that one, I'm sure, but that's where we're at. We've talked in the past about being a little bit anxious about Gentex, so we thought we'd spend a moment on the subject of the general state of affairs at Gentex. About a year ago, we put together the report on the left. You can look at the full report. Here, it's pretty much unchanged. You can actually go to that link. You can see it's a multi-time selection for the roundtable. And I think Cy has picked it since then, so it's actually come in again. But you can see a little bit of a bumpiness, a little bit of economic sensitivity. And again, we're talking about an 8% growth rate company that's kind of fluctuating around here. It's up straight and parallel with some bumps, and that shouldn't surprise any of us. Anything on here bother you greatly, Ken?
No, and I really like what I'm seeing on these pictures here. I'll hold off for just a couple of slides and before I tell folks why we're studying Gentex with the idea that maybe we can do better.
All right, here is the stock price, and yes, it has been bumpy and it has been languishing for the better part of 3 years. As you can see pretty clearly on the right, it's actually down from 36 to 24. That's a pretty good chunk from its all-time highs up in that 36 to 38 range. So yeah, it has been a bit disappointing. Here's our reminder. Again, these guys make mirrors and other stuff for cars, a couple other ancillary products, but they make mirrors for everybody. And when I say everybody, I'll wait. You can try to not find your company on that list. They make mirrors for everybody. And they're pretty well distributed, but by virtue of this slide alone, they are going to be vulnerable and sensitive to what's going on in the automotive industry, which leads us to this picture. The auto manufacturers, again, that's actually trillions on the left in terms of automotive sales worldwide. And you can see that, well, COVID gave us that moment here. And then we came out of COVID and had a pretty good run, much like the restaurants. This is a pretty good run for some of the automotive companies. And then we've hit this flat spot here over the last couple of years. And it's projected to continue for the next couple of years. And there's no way that that does not, I know it's bad grammar, but you guys know what I mean, that puts pressure on Gentex. It has to, by definition. So we know that these economic cycles are real when it comes to automobiles, for sure. Anything here, Ken, or are you waiting for profitability?
I'm waiting for one more slide, I think, Mark.
Okay, this one's the one that bothers you the most, huh?
Yeah, this one bothers me a lot. We've been very disciplined in our approach to most of the stocks that we put into the clubs that I belong to. And we never buy unless we have a reasonable stock selection guide that says buy. Usually that points us to stocks that are going to be able to appreciate somewhere in the low teens to mid-teens. And occasionally we use a report that comes from our accounting system where you can see the internal rate of return for the stocks that you own. It's called investment performance. And you can see it based on each stock, and you'll get the performance for the entire time that you have owned it. When I look at the three different clubs that own Gentex that I belong to, and we put up that report, in our 15 or 16 stock portfolios, I see 12 or 13 or 14 of the stocks performing at least at 12% or better over extended periods of time. And I'm talking about as short as maybe a year, year and a half, and as long as 8 or 10 or 12 years, depending on what the particular stock happens to be. In club after club, in the three examples that I'm pointing to, Gentex is performing down in low single digits. For a long-term holding for the company, in all three of the clubs, the holding is older than 5 years, and in one of the clubs, the holding is 9 years old. And we've added to it at various times when it's been opportune, but we're getting compounded returns of 7. All three clubs are very aware of the rule of 5. And the rule of 5 says that one stock is going to outperform and do just much, much better than anything you can dream of it doing. And we have stocks that are doing that. 3 of the stocks out of every 5 are going to do just about what the SSG says. And you're going to occasionally have a stock, 1 out of every 5, 20% of your choices, that are going to underperform what your expectations were. And you're not going to come up with a specific good reason why that's happening. You think that your analysis have been right on, spot on, and yet the stock continues to underperform. We think Gentex, at least in one of the clubs, is set right now as one of those rule of 5 stocks that we just have lost patience with. We've given it a long airstrip, a long place to perform, a nice stage to show us what it can do. And we just think that maybe we have dead money, and we're going to be taking sizable holdings in Gentex, at least in one of the clubs, and begin to look to place that funds either in other stocks that we presently own or in some new names in the portfolio, because we'd like to boost our par back to something that begins to challenge the indexes and begins to keep our beating the index at 2 or 3 or 4 or 5%. We'd like to get back to where we were, and Gentex is not helping us. I think Mark's given you some things to think about with this company. And I'm not going to move to take it out of the Buttonwood portfolio, but I do think that we have some companies that we could replace it with if the time ever came where Mark had the same feelings that I had.
Yeah, and I think my position would be with Buttonwood and with my personal account is hold it, but also don't let this image get too far from our vanguard. We got to be watching this. They're calling for profitability to basically stabilize and perhaps head back up. Part of the challenge they have is they are so incredibly profitable going back over the years that some of this is a bit natural. But we have seen a decline in profitability. So I'm obviously looking at, well, what's 2026 look like? What are they delivering for 24 and 25 when it comes to the profitability of the company? Because they're still pretty good. I would just be vigilant for selling opportunities if we ever get another RSI like this one. I might subject it very carefully to a look. Well, how are they doing here? If I get any sign of weakness here, along with anything that looks like that, maybe it becomes a sell situation. But I'm with Ken. I think we hang on to it and we just watch it very closely for Buttonwood and in our personal accounts.
Mark, we're in the middle of a serious conversation, so I'm going to unmute Kevin and assume that he's going to add a serious comment to what we're talking about here. Kevin, you're unmuted. Go ahead.
You're in trouble now.
Good afternoon, sir. How are you?
Good. I just wanted to be able to sort of expound a little bit on what Ken talked about with the rule of five.
Okay.
For those people that don't know, the rule of five actually comes from a book, Investing for the Successful Future, which is the Babson and Babson book dating back to the late 50s. And when he was talking about the rule of five, he looked at a study both for income stocks and for growth stocks. And both of them had basically the rule of five. But the thing is that with those growth stocks, you would get extraordinary growth or do extraordinarily well with that one out of every five. And then you could also have it on the other side, whereas the income was a little bit on the, they were muted. They weren't as far as on the extremes, which makes sense for an income stock versus a growth stock. But when we're looking for extraordinary growth, under the study that Babson did, it was really for growth companies. So keep that in mind. If you have companies that aren't, like a McDonald's. McDonald's is clearly not a growth company. So keep that in mind when you're putting together your idea of, how come we're not doing it? So just food for thought.
Absolutely. Thanks, Kevin. All right. Well, you would, of course, consider Portillo's a growth company.
He's muted now. Okay.
So as far as shopping for opportunities outside the portfolio, I just simply went and said, show me the companies that have decent quality and relatively high return forecast. That's what you get with the manifest rank. That's the combination of these two things. And I said, in keeping with our momentum theme from Seeking Alpha and everything else, just show me some that are in the top 20%, top percentile, quintile for momentum. And it's a pretty decent list, Ken. I have to tally you off on the regional banks that propped up in here, but there's some interesting companies. My attention is triggered by Texas Roadhouse. You like this Dorman.
I really do, yeah. And I like Axos a lot too, Mark.
Yeah, and that one showed up in, many of these actually showed up in Groundhog portfolios also.
Yeah. We're getting a couple of questions from the audience about what stocks would you replace Gentex with, and
that's what we're doing now. Yeah.
But my clubs are not going to fall into the trap, I will call it, of having to replace something with a peer.
Oh no.
There's no necessity to replace it with a peer. A lot of times we will look in the same sector to keep our sector balance reasonable, but we don't pay that much attention to sector balance. That usually takes care of itself. So I think a good, solid, generalized screen like this one, and then choosing companies off the list that you think are very interesting to study, and then submitting them to a study that includes a couple of peers. So if we're seriously considering Texas Roadhouse, that brings up, let's study 3 or 4 of the restaurants. Dorman Products is, it's in the same industry as Gentex. And that's a coincidence rather than something we would be looking for. Axos is a regional bank. And again, if you're going to study regional banks, let's look at 3 or 4 of the top regional banks in the country before we decide that Axos is the very best.
Absolutely. So we basically have done that, and we've been talking about Mercado Libre as a potential accumulation stock. Again, we have that. Let's see, I forgot to hit reset, Ken, so we only have $38, but we actually have $140. So I injected Texas Roadhouse into the portfolio just to make the comparison of, how would these two compare as replacement candidates? We're gonna keep Gentex in the portfolio, so we're not gonna have that additional $200. But I would be in favor of Texas Roadhouse at this point with our cash. Your thoughts?
I'm just counting how many are in the portfolio. I think we have 17 in the portfolio right now. Did I count correctly, Mark? Okay, so that would make 18, and I can live with an 18 stock portfolio. Yes, so I don't have any problems in adding Texas Roadhouse as a. We're kind of nibbling at it. It won't be a full position right off the bat, but it definitely has the characteristics that we're looking for. We're not being as formal in the Buttonwood portfolio as looking at all of the competitors, but I think we could have just as easily looked at one or two of the other restaurants and decided to put it in the portfolio as well. I'm very pleased with Texas Roadhouse, so let's put the $100 there. That's okay with me.
Yeah, and I think right now we're not going to do it now, but I think Excellus can probably come under the microscope. Lowest growth rate and just a little bit less exciting company, and maybe we can find a better home for $78. Who knows? But that may come up in the future. But for now, we'll just take our cash and put it in Texas Roadhouse. All right.
Yeah, almost the lowest quality rating on Excellus also.
Yeah,
there is
in fact,
one sticking out ahead of it, but you know.
Well, that one's our rainy day stock.
Yes, it is our non-traditional investment. Okay.
He's not here, so we can't pick on him too much.
We won't.
All right, so we'll go ahead and do that. Okay, here's a quick reminder that we do archive all of these sessions, roundtables and bull sessions. Every once in a while, we do a special session. By the way, Ken, the Tub Gators are going to roll off the screen. So Tub Gate XL is the next one, right? No, LX for Super Bowl 60. Tub Gator
60,
LX.
Right.
Yeah.
60.
That'll be coming around. But this session here, this is one of those Heart of Illinois sessions at breakfast. This one was actually, I don't remember whether it was breakfast or not, but we ended up demonstrating a bunch of AI stuff. We called it caffeinated intelligence. It's an interesting, it was an interesting discussion. We would invite you to explore that. I see the number of people already have. All right, our February roundtable's in a couple weeks. That is our award ceremony. And we leave with the reminder that Valentine's Day is right around the corner. If you didn't already know that, it's probably too late. All the restaurants are booked up, but at least now you know what you were forgetting. Good stuff. All right. Anything else, Ken, as we wind down here?
Well, I think you should remember what you just said, Mark, about Valentine's Day in the restaurants, because that's this coming Friday. Okay?
Yeah, I know.
Okay.
I wonder if things will be better Saturday. Maybe we should shoot for that. Okay. I'm inspired. I'll let you know. Anything else we need to kick around?
Nope. Just everybody have a good afternoon, and we'll be back next Tuesday at 2:00 to give you another bull session.
All right. Take care, everybody. Let us know what you'd like to hear about, and good luck, Groundhog Nation. Take care.